Good morning, guys. I'm not sure if I'm going to do this as a daily thoughts video. This is going to be more about a different topic that you guys may be familiar with or you may not be familiar with. Specifically today, I'm going to talk about crypto and NFT taxes. It is, let's see, I think the 8th of March right now. So we are coming up on the end of tax season when you have to have your taxes filed, which is April 18th. And some of you out there, a lot of you who are in crypto and NFTs may be wondering, what the heck am I going to do about all of these transactions that I have going on, specifically with crypto and NFTs? This is kind of a complicated topic right now because cryptocurrency by itself is very unregulated in a lot of ways, but it's the rules under the tax liabilities for cryptocurrencies right now is very, very similar to regular stocks and securities in that regard. However, when you get into the NFT world, non-fungible tokens, for those who don't know, non-fungible tokens have some interesting little caveats, and in a lot of ways, NFTs are not regulated at all, really, and they're considered almost an asset. They are considered an asset under tax law right now. So there's a lot of interesting things that are going on with that whole world. And for those of you who haven't already, make sure you like, subscribe to the channel so that you can get some more information on this, because I'm going to be covering NFT taxes and crypto taxes here quite a bit. I haven't shared this with you guys yet, but I did taxes for about 5 years when I was a younger man. When I had just got out of high school, I started doing taxes for one of the large companies that are out there, and I did almost primarily just basic returns and like schedule 1040As and stuff like that were not too complicated. As I've gotten into cryptocurrency and NFTs, as I've gotten older, I've started to realize that there's a huge niche out there for crypto and NFT tax information. It doesn't seem like there's a lot of people out there that are even talking about this, or that are even want to talk about this, because it's a very complicated subject. Regardless, NFT taxes are going to be extremely interesting. Crypto taxes are very interesting because there's a concept of capital gains there if you hold them for long enough, and the appreciation or depreciation of a token, whether it's a actual cryptocurrency or whether it's a NFT token, is very interesting because you have multiple layers of appreciation or of realized profits on these assets. So NFTs in general are a very, very difficult tax subject because you're going through multiple layers of realized or unrealized gains when it comes to these assets. When you buy an NFT, as many of you know who are in the NFT space, you are buying that with a cryptocurrency of some kind. There's all different kinds of NFTs that are purchasable out there. You have the main one, which is Ethereum. Ethereum is the main NFT platform that people are using, and the main blockchain people are using to store, trade, whatever their NFTs on. You have Cardano. You've got, there's all different. There's now Bitcoin NFTs. There's the list goes on. There's Solana. The list goes on. But it doesn't really matter what the cryptocurrency is. The laws and the regulations around that are fairly similar, regardless of what you're doing. You're essentially buying a token or an asset, the NFT itself, with a cryptocurrency. And so the realized gains or realized losses of that asset are going to go through two different layers. When you buy the cryptocurrency itself, and then when you buy the NFT, that is going to be your basis, your cost basis of whatever you're purchasing. So let's say you buy Ethereum at $1,500, which is about where it's at right now. Let's say you buy 1 ETH, which would be $1,500. Then you buy a NFT for 1 ETH. So that the cost basis of that NFT is 1 Ethereum or $1,500. Now let's say you hold on to that NFT for, let's just say, a year to make it simple, okay? You hold on to that NFT and then you sell it, let's say, for 2 ETH. So now you have to go into the calculation of, well, okay, so I bought this for 1 ETH, I've sold it for 2 ETH, so I have 1 ETH of profit in this one NFT. Okay, so now once you have your 2 Ethereum from your sale, then you have to look at the price of the NFT itself, of the Ethereum or whatever the token would be, but in this case, let's talk about Ethereum. So you have 2 Ethereum, and let's say Ethereum went up to $2,000, okay? So Ethereum You have two of them. It would be $4,000, and if you cash out that that Ethereum, you would have $4,000. Okay, so your cost basis is $1,500. Your realized gain would be the $4,000 for the two Ethereum that you cashed out, minus the $1,500. You have $2,500 in realized gains. Okay, now that sounds pretty simple, but then you get into the tax implications of that. Okay, so if you were not holding it for a year, it would be taxed under a regular income structure, which would be just add that to your realized gains when it comes to capital assets on your scheduled return. And that would not be very, very complicated. However, if you've held it for a year, there is another schedule that allows you to take what is called a sorry, I'm trying to move my stuff around. It's what's called capital gains. Okay, now capital gains is a specific set of let me turn this off. I thought I need more light. It is a specific schedule of taxation when it comes to assets that are held over a certain period of time. Most of the time it's over a year. Okay, so there is a schedule where it's at 5, 10, and 20% depending on the asset itself. But it allows people who hold assets for longer, which is the goal, is they want you to hold the asset for a little bit longer. It allows you to be taxed at a lower tax rate than a normal asset would if you were to buy and sell a regular asset. So let's say, because if you guys know anything about tax and you've done your tax return before, you have a progressive tax rate in the United States of America. The more money you make, the more you are taxed at it. At the top tax bracket, you're looking at 37% for the federal taxes. State taxes are varying between all different kinds of states. The point of the capital gains is to bring that tax rate down on assets that are held longer. Okay, so if you hold an NFT for a year, you could instead be taxed at 20% on the realized gain of that $4,000 in our example. Okay, which would be much better than being taxed at 37% on that $4,000 sale right there, which would be $2,500 in realized gains. Okay, so it does make a big difference when it comes to holding NFTs. And that's why a lot of people are kind of in this zone right now where they're not exactly sure what to do with their NFTs. A lot of people are holding long because the NFT market has been down. A lot of people cashed out in 2022 when the market started to take a dip, in the beginning of 2022 towards the summer. And so there's a lot of rules and regulations around that are still undefined, but from the tax structure that we have now, we know a couple things. Holding NFTs long is going to get you a better tax rate, which is going to mean a lot for a lot of you out there. I have a lot of friends in the crypto and NFT space who trade NFTs on a daily basis. We're talking about, let's just say 1, 2, 3, or 4 transactions per day where you're trading NFTs back and forth. And speaking of trading an NFT one for another also will incur a realized gain depending on the value of that NFT. So this is a very complicated subject when it comes to the realized gains of an NFT specifically, and then you get the cryptocurrency layer on top of that. So the price of cryptocurrencies, when you buy, when you sell, when you cash out, all of this kind of stuff comes into play when it comes to NFT and crypto tax liabilities. This is a giant subject that we need to talk about. I'm going to continue to do videos like this because I think it's important to talk about them. But I'm going to keep this one short for now. If you guys are interested in NFTs, if you are an NFT trader, or if you're into crypto, follow me on all the social medias. Rumble is David Coleman. YouTube right here, if you're watching on YouTube, is David Coleman, obviously. My Twitter, which I talk a lot about finance, is Colma63ETH. And then my Instagram is David Coleman YT. So in the future, I want to talk about tax loss harvesting, which NFT guys do a lot of, especially when they have a lot of tax liability when it comes to NFT sales. We also need to talk about founders. The founders out there, if you guys don't know yet, if you're a founder and if you created a project, you have technically a small business, and you're going to have to file a Schedule C on your tax return, which is going to cost a lot of money to prepare. It's going to take a lot of preparation to do so, and it's going to suck. So there you go. If you guys have any questions or comments or questions, put them in the comment section below. But besides that, I will see you guys on the next one where we're going to talk a little bit more about all these topics. So thanks so much for watching, and we'll talk to you next time.